Welcome to this detailed screencast on the topic adjusting journal entries. One of the questions students must ask is, what is an adjusting journal entry, and why do accountants need to learn about them? To ensure that revenues and expenses are recorded under the accrual basis of accounting information systems inside of a particular business use adjusting journal entries. The definition of an adjusting journal entry are entries that are formed in the general journal to record revenues that have been earned but not recorded and expenses that have been incurred but not recorded. There are 4 common scenarios for adjusting journal entries. These are listed as follows: deferred revenue, accrued revenue, deferred expense, and accrued expense. A deferred revenue is when a company receives cash before they earn revenue. An example of this is when customers go to top up their Opal cards with cash. As a customer, you pay Sydney Transport before using their services such as trains, buses, or ferries. An accrued revenue is when a company or entity provides a service and then collects the cash. An example of this is if you have a personal trainer at the gym. At first, you have the workout session, and then once that session has concluded, you pay the trainer the money they are owed. A deferred expense is when a company or entity pays cash before they incur the expense. A common deferred expense is when someone leases or rents a house. They pay for the rent in advance to actually using the space, and this could range from a couple of weeks to a month. An accrued expense is when cash is paid after the expense. An example of this is when a company pays for its employees' wages when employees work. They don't get paid straight away for every second that they are at work. They receive the payment potentially 1 to 2 weeks after their initial services have been performed. Thanks for watching, and I hope you have learned something new.